In this week's update, a big lesson in long-term investing. US deficits won't be cut, what gains a big advantage, and silver finally gets its turn. My name is Garry Davis. I'm an authorised representative of Primary Securities, and the information in this video is of a general nature only. Okay, this is going to be a quicker video because I am travelling overseas at the moment, but certainly plenty of important things to talk about. So some lessons from the last 3 months since all the upheaval that the US government policies have precipitated. First of all, I think it's worthwhile contemplating what has happened and how we could have best responded to that. So overall, markets hate surprises, and markets got an enormous surprise when Trump announced the Liberation Day tariffs. That was way beyond what anyone expected. And so that was always going to bring a pretty negative reaction. And as I said, he went well beyond what was expected. And the other aspect to consider is Trump, being a capitalist, was never going to crash the market on his watch. It was never going to happen. So no matter how severe the market reaction was, he was always going to be forced to back off. So you've just got to step back and think about the probabilities that a sustained market crash or correction was going to eventuate from what was happening. It was always going to be a transient situation, unless, of course, it got completely out of control. But fortunately, Trump pulled back from the brink of the bond market falling apart before that happened. The next important thing to do is to contemplate what actions you took. Did you react in some sort of panic along with the rest of the crowd? Or did you manage risk according to a clear plan that was accompanied by crystal clear exit rules? And the final point is, are you now well in front of the pre-Liberation Day value of your portfolio? Because if you kept your head and you'd responded in an orderly manner, then you probably are in front, and possibly quite well in front. Now, when we look at US economic policy, and this is at a big picture level, this is the likely direction, and this is not just related to the current administration. This is related to what's been happening in America for the last 3, 4, 5 decades. So the likely direction is that deficits will not be cut. And when you think about it, governments are never terribly focused on efficiency. It's just a foreign concept to governments, not only the US government, but nearly all Western governments. And so we end up with ever larger budget deficits or ever larger budgets and the exercise of just raw power, which is controlled by those vested interests. And they're wedded to that. It's going to be virtually impossible for that scenario to change. And of course, all this gets financed by taxes and by inflating away the debt, so reducing the value, but that penalizes the consumers. So long term, it's likely that we're going to get massive inflation. But we've been in this position for several decades now, and people have been predicting all sorts of dire things that haven't eventuated. So this is very big picture stuff and may not eventuate within any sort of reasonable time span. But it's worthwhile considering where the long-term direction is heading at the moment. So the only question is when and how this inflation, which would appear to be inevitable, how it manifests itself. But it could be another decade or 2 decades away. So it's always advisable to be guided by what the money flows are telling us, not by what the fundamentals would indicate is a logical conclusion, because it might just be so far off in the distance that it doesn't matter. But of course, what sector is going to benefit most from that sort of massive inflation breakout? And there's no prizes for that. It's precious metals. Importantly, you need to make sure you've got all the required investment advice that you need, financial advice, legal advice, and any other advice before taking action in the stock market. Now, just a quick snapshot of what happened with the American market. The S&P rose 1.5% for the week, and the NASDAQ did better rising by 2%. But Russell 2000 for small caps was even better again, 2.5%. And the RSP was up by 1.3%. That's the equal weight. There were major gains in technology, as we'll see on the chart in a minute. And this is really a market that wants the good news and is ignoring the rest. And there's been plenty of negative news events in the last week, but the market's just ignoring for the time being and seizing on the positive. That's a very good sign. The US dollar is lower, down to 99.2, under the expectations that we're going to have a fairly dovish Fed policy in the next 6 months. The 10-year yield has crept up a bit though, so the bond market still has its concerns, up to 4.5, and the VIX index though fell quite sharply, down under 17. So let's go and look at some charts. This is the NASDAQ on a daily chart. So you can see we had a little bit of selling and indecision in the last couple of days, but basically it was a very positive week. And if we look at the semiconductor sector, they certainly had a very good week. This is on a weekly chart, so they've recovered very strongly from post the Liberation Day upset, where the SMH index was down to 170. Now it's back up above 255. If we look at the money flows, clearly technology had another very good week, followed by consumer discretionary and then communication services. And then we've got materials. So all the more aggressive sectors doing well last week. And the S&P on a daily chart also finished quite well. So that's the American market, the Australian market. The Aussie dollar finished at 64.3, and the ASX 200 index rose 3.6% for the week, with banks and energy leading the way. And as far as the best type of stocks that I talk about very regularly and that are the absolute predominant focus in the Insiders Club, they had another absolutely cracking week, and it's been a tremendous run since the turn in April. We look at precious metals. Gold was down by $49, down to 33.10. In Australian dollars, that translated to around 5,100. But the big mover was silver, sharply higher to 36.58. So a significant breakout there in silver. And the gold and silver ratio is sitting at an extreme level that you don't see very often. It's quite rare. And when you get to those levels above 100 to 1 in terms of the gold to silver price ratio, then there is a very, very high probability that silver will start to outperform gold and do so quite dramatically. And we saw that last week. And the odds are, and this is not a big sample size because it's not a particularly prolific event, but when the gold to silver ratio gets above 100, there is a 100% success rate for silver to make major gains over the following 6 to 12 months relative to gold. And this doesn't guarantee us anything, but it is now highly, highly probable that silver relative to gold will have a very good run in coming months and possibly through into next year. So let's have a look first of all at silver. So you can see on a big picture weekly chart, we've now broken out to levels, and you've got to go back to 2012. So a bit over 13 years since silver's been at this level, and you can see it's a very strong move on a weekly chart. If I just narrow in on that a little bit, looked at on a daily chart, then you can see a little bit of selling came in at the end of the last 2 days, but this is a very emphatic breakout. If we look at gold, there's gold down with most of the damage done on Friday and in Australian dollars. That is how it looks. All right, turning now to other commodities. Copper was at 481, hadn't moved much, neither had nickel. Crude oil, after breaking support and getting down to around 58, 59 and looking like a significant slide could be on the cards has now reversed and stabilised, and we've even got a little bit of renewed strength. So it's a bit of a teaser market, the crude oil market at the moment. So wrapping things up, just contemplate the last 3 months. I think there's an enormous amount of value in doing that. If you don't stop to think and learn about your experiences in the market, then you'll never get anywhere. But equally, if you do regularly stop to think and contemplate about how you've responded in the market, then you'll continue to advance as an investor. So contemplate the last 3 months. The Liberation Day smashing seemed dire and was dire for a period of time there. The market reacted very badly to it. But then, of course, Trump had to back off and the now famed takeout trade came along, and that changed things just as abruptly as it had started them. So it's another example of the value of just stepping back, not overreacting quickly, certainly not going with the crowd, and just underreacting to some events. Give yourself a few days or a week just to absorb what's going on and see whether it makes sense or not. When it really gets back to the benefits around having a clear plan and being confident to execute, even when you've got things going on like we saw in April. There's a great learning exercise which comes immediately at the end of this quick review. It was an excerpt that I did in response to a question in Portfolio Analyst. It's about the ability to observe, to acknowledge, and to respond. And I've talked about that quite regularly in this Sunday video. So a great learning exercise. All right. Now, you also asked the question in the Sunday podcast on the 11th of May, you mentioned the ability to acknowledge and respond decisively. How does one do this regularly? What steps and suggestions to take? Firstly, Jade, I applaud your desire and need to learn because, it's the only way you get better in financial markets. Look, this is one that you can't achieve overnight, and there are so many aspects to it, and quite a few of them are psychological. So you've just got to continue to do things that make life easy on your psychology. But look, here's some pointers to start with. I think you need to set up a daily routine and consistently watch whatever it is that is important for you. There's a massive amount of things that I watch, but I do it many, many orders of magnitude for more than your average investor would do. So whether it's indices, whether it's individual stock charts, related markets such as the bond market or commodities or currencies, whatever it is, get a daily routine that is quick to do, because if you've got to spend an hour or 2 hours a day doing this stuff, it's going to break down. It's too much. So you need to be able to deal with it very, very quickly. But the key thing is staying on top of things. So you want to be in a position where you can do it every day. So maybe take 5 or 10 minutes and you just quickly eyeball the charts that are important to you. So first of all, get into that routine, and that routine gives you confidence to trust the charts. That's what this is about. Observing, acknowledging, and responding is about trusting the charts, because often the charts are telling you things that are seemingly illogical. They don't make sense. You go 1 + 1 should equal 2, but it's not. And the charts, hazard a guess, are always right. So the more that you can learn to trust the charts by having this daily routine, then the more open-minded you're going to be to changes in character in the charts. So that is really important. Not getting caught up in the flow. We get caught up in the media narrative, the flow of what everybody says and thinks, and it's easy to fall into step with what everybody else is thinking. And also, when things are going well, we don't really want to change anything, and we don't want anything to change. So that's why we tend to miss the big turning points, because we get used to the trends going either up or down. And psychologically, we expect that those trends will continue. And so we're less likely to acknowledge the change of character. The next thing is just to understand the importance and the priority of chart pattern signals. And the only way that you can do that is just to do it diligently over a long period of time to build trust. I think that is the main thing. If you trust that the charts are giving you accurate information, then even if it conflicts with the logical conclusion, then you'll go with the charts. The next thing is you've got to lose the fear of crystallizing a loss. So I know I get emails from people who say the chart of XYZ looks terrible, but look, I'm behind. I'm in a loss situation, so I don't want to sell it. I mean, it's just such a crazy state of mind to be in, because what you're saying is, I own something, it's underwater, the price is going down, but I don't want to sell it. I don't want to sell it and buy a stock that's going up. Just think about that. It's not logical. So try and lose the fear of crystallizing a loss. You need to think about it is, you're going to move that parcel of money from something that's making a loss for you and getting bigger. I'm going to move it into something that's going to perform much better. That's how you need to think about it. So look, overall, it just takes time in terms of years to build your trust, but you don't want to spend very much time on it per day. You want to be able to do this quickly. So really, it's about conditioning your psychology. So hopefully that starts a good path for you. Portfolio analyst coming up this week, more insightful Q&A, and I think you'll find a lot of value in that. So that's it for this update. I'll be back with you shortly. Cheers.